Welcome, everybody, to Martinis with Scott, a show about winning momentum in business and in life. We are on YouTube, Apple Podcasts, Spotify. If you like us, please subscribe. Most business owners and entrepreneurs think that the worst thing that could possibly happen to them is they lose their business, but that's not all. In many circumstances, or there are many circumstances where directors, entrepreneurs, owners, managers, professional directors, officers, of companies like a CFO, a president, COO can become personally liable to other stakeholders of the business, even when they have incorporated companies. What are stakeholders? Think of governments, secured lenders like your bank, unsecured creditors like your suppliers, other shareholders. Those would be examples of stakeholders. And there are instances where, as an officer or director of the business, you could become personally liable to those stakeholders. What triggers those personal liabilities? Think unpaid wages, vacation pay is a big one that directors and officers of medium, smaller businesses in particular often miss. Statutory remittances to the government, breach of trust, oppression, trading while insolvent. So there's a lot of different ways. Those are just a few. There's many different ways that you can become personally liable to stakeholders as a director or an officer, even of an incorporated company. On this episode of Martinis with Scott, I have a conversation by Zoom because we are in virus times with David Cohen of Gowling WLG on how we get in trouble as a director and officer and strategies to avoid those pitfalls. It's a great discussion. David is truly an expert in this area. He's a national leader of Gowling WLG's Financial Institutions and Services Group in Canada and a senior practitioner in the firm's Toronto office. He practices in areas of corporate commercial financing, restructuring and insolvency law, both domestic and a cross-border context. Cross-border in this instance means the U.S. David also coordinates the firm's distressed M&A practice for 7 years. He's been consistently recognized as a leader in the areas of restructuring and insolvency by Chambers Global. He's also listed in L'Expert as I say that with a French accent, just assuming that that's how that's supposed to be said, as a leading lawyer in mining in 2017, 18, 19, and debt financing and banking. David's recent matters have included restructuring of a large agricultural product manufacturer and producer, liquidation restructuring of a number of large domestic Canadian retail chains, restructuring of mining businesses and oil and gas producers. He is the past global chair, and past global president of the Turnaround Management Association, which is the number one international global association of turnaround and insolvency professionals. He was chairman of that and president of that, served as a member of its executive board of directors and board of trustees. He was the chair of the Canadian Bar Association's National Bankruptcy and Insolvency section executive for a two-year term, member of CCH Corporate Law Advisory Board, and was a visiting instructor in bankruptcy law at Osgoode Hall. I assume that is in Toronto. Every director and officer of every business in every jurisdiction needs to know how they can become personally liable, to whom, what triggers those situations, and how do they not get themselves into that problem. Enjoy the show. It's a great discussion. David's one of my favorite guests to have a martini with and to have a chat. Thank you for listening to Martinis with Scott. If you like the content, please subscribe. YouTube, hit the subscribe button, Apple Podcasts, Spotify. Enjoy the conversation.
Hey, David, how are you?
Good, Scott.
Good to see you. Cheers, my friend.
Salut.
Oh, look at you. Got a nice colored scotch in there. Is that a Lagavulin or a Lafroig?
That is Glen. I don't know what that is. Oh no, that's the Balvenie Portwood 1991.
Ooh, sitting there in the Gowling WLG office. I like it.
Get the glass.
So, David, you are a little bit of a guinea pig today because we're doing our first Martinis with Scott over Zoom and into our new format of going back to weeklies and doing interviews and and not interviews, discussions with somebody as opposed. I've been doing a lot of shows, but just me on my own. So it's great to have you. Thank you for agreeing to do this. And I also wanted to thank you for last week. We did I was a panelist on a webinar that you hosted, and that is being released in 1 minute live on the Martinis with Scott channel. So that'll be coming out. So thank you. That was a great experience.
Well, we appreciated you coming on board and as a panelist. In fact, we got a lot of great feedback about your presentation. So
Excellent. Excellent. So today, excuse me, Martinis. Today we're going to talk about director and officer liability as best we can, which I think is a hot topic these days because every time I try to reach you, you're off talking to a board about director and officer liability. True story?
Fairly true. There's been a lot of activity in conversations with boards of directors about, you know, what the scope of their duties are, what their the liabilities of the officers and directors are, and what their choices are for sort of dealing with liquidity issues, dealing with stakeholders, which you and I talked about before, and just generally wanted to get a feel for the subject matter. Nothing urgent, nobody is moving, but prudent boards are getting advice now.
So the current environment is making them think about, hey, what does this mean for me personally as a director? One would think.
Oh, I think they've looked at their cash flows and if you're looking at your cash flow right now, and you know, we talked a little bit about cash flows before as well, but when you look at your cash flows and you've got a finite amount of cash available, you have to decide, you know, how long you can continue to operate. It's very unique in the current circumstances, though. We'll get into that a little bit, I suspect. But it's very unique because a lot of the businesses are already paused. They're not incurring further liabilities. They've laid off an awful lot of employees. They're not buying from suppliers necessarily. And really what they're dealing with is lenders and landlords to a large extent, and employees, you know, who stays with us.
Yeah. So for those of you watching this a year from now, for our listeners that are watching this a year from now, we're shooting this during the COVID virus. So it's very unusual what's going on here. But what we're going to talk about today is relevant to all times. It's just been highlighted with this current liquidity crisis, correct?
Yes. And we should probably keep our comments more general, not just to
exactly.
COVID. Right.
Exactly. Okay. So let me set the table a little bit, and then we'll get into the meat of this, okay? So for our audience who, you know, business owners, directors, entrepreneurs, owner managers, people that have that director officer hat for whatever reason, this is about you becoming, or these people becoming personally liable to somebody who has sued them or taken some action against them. And notwithstanding that they're, you know, incorporated in Canada or they're a C Corp in the US and they have this corporate protections, all of a sudden they're personally liable for whatever is going on, right? That's what the essence of this is.
I mean, it's both directors and officers. We're going to talk about directors more today than officers, and unless you want to talk about officers, the crux of it is that there are director liabilities for certain types of activities and behaviors that attribute directly to the directors. They don't get the benefit of the insulation from the corporation, the corporation's liabilities. And, you know, it's usually around things that if you put on your common sense hat, make a lot of sense. You know, I think the first thing you sort of ask yourself is what are we really trying to teach here to people? What are we really trying to help people with? And it's common sense, right? You just look around and say, would somebody question this behavior later? And if you can answer that question, maybe, then you should take a step back. And that's, you know, of course, to the exclusion of narcissists who don't ask that question. But for everybody else, you know.
Or people in trouble, businesses in trouble, or businesses in high growth because it's chaotic and you've got 800 things you're doing a day and you're not thinking, right? And that's kind of one of the points that I've learned is that if things are stable and you're just ticking along and you're a good manufacturing company and nothing's great, nothing's terrible, you're not going to have these issues because you're paying your bills, you're talking to your lawyer, you're dotting your I's, you're crossing your T's, right? This is really never going to arise unless you do something stupid, right? But if you're a high growth, whatever industry company, if you're a cannabis company 2 years ago, if you're a tech company and you're in high growth, or you're a company that's teetering on insolvency and the momentum's going the wrong way, that's when you forget to make the right decisions as an owner manager, as a director. My experience.
Yeah, I mean, particularly inside of what we call the zone of insolvency. It sounds like something from the part, the dome of the dome of silence or whatever it was. Inside the zone of insolvency, your behavior has to become acutely self-aware. You have to pay a great deal of attention to your decisions and make sure that your decisions make sense in the best interest of the corporation.
Right. Code of silence, Agent 99.
Oh, that's right. Agent.
My favorite show.
We're dating ourselves a little bit.
Yeah, exactly. You go YouTube that. All right. So a few years ago, I was asked to step in to fix a company in Western Canada that had been the victim of what the lawyers termed to be misappropriation of funds from its primary shareholder and director. This is a statement of claim. And I would call it fraud, but I'm not a lawyer. That's just my layman's interpretation. So they wanted to get rid of this fellow, and they needed somebody to try and save this company. So I stepped into this. This is a Canadian file. I stepped into this and I agreed, I'm going to skip a few steps, but at the end of the day, I agreed to be president and sole director of this company. Now, I think that was clearly a troubled company. Now, I think that I would be probably the only turnaround professional in Canada that would take on that role. Certainly none of the larger firms would do that. I don't know that for a fact. You know way more about the space than I do in terms of my competitors. Am I the only one that would do that, or one of the very few?
Well, if I was being candid, that list is very short.
Yeah.
I have that list, and you're on the top of it. And you're on the top of it because you have an approach to going into these businesses that is mindful of that circumstance, of the fact that you're going into a troubled situation.
Right. So clearly in my engagement letter, I'm going to get an indemnity from the lenders and from the company itself. But who the hell knows what that is worth at the end of the day? So I get stressed about these things. And so how do I evaluate this? This is just me setting the table, okay, for this discussion today. So the way I evaluate it, right or wrong, is I think about the stakeholders. Because the one thing I learned years ago is there has to be a counterparty to sue me if I'm going to have director liability, right?
Yep.
Someone has to care. So who are those stakeholders? And so I start with government. And on government, I'm worried about deemed trust, statutory obligations. And we're going to get into these in more detail in a minute, but I'm just telling you how I think about it.
Yeah.
So make sure I'm paying my withholding taxes and my HST, right? And I'm worried about environmental, but I don't really understand that law, and it wasn't relevant to this particular file anyways, but that's something that would go through my brain when somebody asked me to do this. I'm worried about the bank, but that's easy. That's a stakeholder. But my mitigation there is don't steal from them, right? Just do what the loan agreement says, and I'm going to be fine as a director. A landlord is a stakeholder, but I don't know of anything that I could possibly do to create personal liability on the landlord side other than to contaminate their property in some way maliciously or criminally. So I'm not worried about that. Employees, I could be personally liable by not paying them, by not remitting my statutory amounts to the government. And they have some sort of, depending on your jurisdiction, there's some sort of labor board remedy to director.
Wages, vacation pay.
Yeah.
In some cases, under the Canadian Labor Code, a severance.
Right.
Up to 6 months. And
right. Okay.
Those can be big numbers.
It could be. And vacation pay is a huge one.
Right.
And we'll talk about that more. I think about my unsecured creditors, which means suppliers predominantly. There's other unsecures, but for the most part, suppliers, which is always an interesting issue that I don't want to say I struggle, but having a methodology to cover yourself as a director on those is always an interesting thing that we'll get into more. And then the shareholders, which really boils down, I think, as a director liability to duty of care and loyalty. So when I agree to take on this file, that's how I think about it. I list out my stakeholders and what could I do wrong to cause them to sue me personally. Is that a good way for our audience, for directors, to think about how to evaluate their risk?
Yeah. Yes. Yeah. I think it is. I think it can get a little more subtle than that around, how to weigh them
Sure.
and balance the competing interests of those parties, because the competition between those parties can actually cause you, and picking a side in the fight, so to speak, for collateral or wherever the value is.
Yeah.
Is where it starts to get a little bit hairy. Also remember, the people who sue you are the ones with the deepest pockets who want to sue you. They're not necessarily
or who are the craziest.
Vindictive is another good
Yeah.
word. And if they've got a personal beef with you, that's going to come out in it as well. Look, I can pass you on the street, get your name, find out your home address, and commence a legal proceeding against you, Scott.
Right.
And the only thing that's going to
In
stop
fact, you have in the past.
I have not.
Us being neighbors.
I might now.
Yeah. Okay. So on this file, two things came back at me, right? Because you never step into this messy situation, and you have to be prepared for things that go crazy. So one is HST. So the government came and said things weren't filed, and this is a year after the fact that I was off the file, and I was fine on that. And the reason I was fine is because this company went through a bankruptcy and a sales investment solicitation process that was court sanctioned, and M&P was on the file. It's all public information. And, to me, and then they rolled into a new company. The creditor did a credit bid, started again. And so and I ran that new company as well. But from my perspective, this is the trustee's problem, right? So we're going to talk about how you protect yourself at the end of this show. But one of the things is to do something formal with lawyers like yourself to go through a bankruptcy court, bankruptcy process to get yourself off the hook as a director. Have I got that right?
Yep.
Yeah. And the second thing that came back at me was the shareholder and director who initially created the alleged misappropriation, then sued and made a bunch of complaints to various bodies that, in effect, I want to use your language, and I'm not a lawyer, but trading well insolvent. So is that the right phrase? So explain what that means.
But in its most basic and simplest terms, when you buy something or continue an employee working in your company, and you reasonably believe that there's no way you're going to be able to pay them, right?
Right. Or a supplier.
Or pay a supplier, right?
Yes.
Particularly, it's payments of money that really matter in this. So when you know that you can't honor that financial commitment, and you incur it nonetheless, you're trading while insolvent. I mean, and that attracts anger. It's a poor judgment, but there's that fine line of knowing when you're actually insolvent.
When do you pull the plug? That's a big issue as a director, right? So go ahead.
I've looked at this for a long time, and we all scratch our heads about at what point do you pull the plug, and what's insolvency, right? Like the problem you have that everybody knows, there's two tests for insolvency that are really relied on in bankruptcy and insolvency cases. And the first one is the balance sheet test. Assets are less than liabilities. The second one is the cash flow test, or what the going concern, meeting your debts as they generally come due. In fact, the Bankruptcy and Insolvency Act uses that exact language, that you can't meet your debts as they generally come due. Well, most startup corporations, the entire cannabis industry, arguably, right now are arguably underwater on the balance sheet test. And on the cash flow test, they may have sufficient cash to meet their debts as they come due, but there's a point where that's not the case, right? And this is something you and I've talked about before, and it's the, when you've got, let's give it a tangible example. You've got a small company and they know they have 3 weeks of cash flow left in the bank account. And this is what I get called in to talk to boards about all the time. We've got a month's worth of cash flow left. And at the end of the month, we'll pay the last employee and we'll be done. And the question is first of all, if you're incurring liabilities in that period that are not going to get paid, you're trading while insolvent. But what if you're out there trying to raise, angel financing or distressed financing, and you're in conversations with a number of creditors? Well, I like to make the distinction, and it's pretty simple. There's a difference between a realistic expectation that you're going to find a solution and hope.
Yeah.
If you slip at any point in your conversation and you say, well, I hope to get the money, you're cooked. You're cooked because your own personal, desire to do something versus the facts that are actually there before you are two different things. And this is where you need, as a director of a company, to sort of detach yourself from your ambition and your known ability.
Which is a great reason to have an external director who's independent,
right?
Who has some smarts and some judgment that's not biased by the stresses of the day-to-day, right?
Right. And who isn't talking to all of these financiers or angel investors or distressed lenders or their uncle or their aunt who says they're going to give them the $50,000 they need. The problem becomes every single time there's a point in the timeline. You start here, you've got a reasonable expectation, and somewhere along here it goes from reasonable expectation to hope. And now we're over here at hope. And the moment you're at hope, you need to have a really hard look at your cash flow, and you need to figure out that you're not incurring HST liabilities, because they're calculated in arrears, or you don't have vacation pay plus wages plus severance that, somehow you're not going to meet. Because if you don't meet them, there is that director personal liability associated with it. You've got, in some cases, you have a due diligence defense, but you can't say it's due diligence when you only have hope that you're raising the money.
Yeah, exactly. I got to go back to my Western Canada thing in a second, but I just want to follow up on that hope conversation, because I've probably been involved in not 1,000, but several hundreds of VC, not necessarily startup. I've done a lot of startup, but early stage. We're out looking for venture capital money. We're doing angel investment, high growth. Well, hoped high growth, which is the point of the conversation.
I think we call it pre-revenue is the polite way of saying it.
A lot of them, or 500,000 in revenue, $1 billion in revenue. Let's say it's 500 companies. I'm just making that up, but let's say it's 500 companies. I bet you 50 of them to 100 of them were missing payroll. They had no ability to know that they could pay their remittances next month or the last 2 or 3 months. Like, this is, David, this is normal course in entrepreneurs trying to start a company. And to me, I don't know how technically, based on what you're saying, they're not insolvent and they shouldn't be pulling the plug based on this hope issue, because you're out trying to find angel money, right? You're trying to find the next 100 grand. You and I worked on a file, what was that, 6 months ago? It was the exact, and they were a big company, but it was the exact same thing. They're literally out trying to find the next, in their case, $1 million from somebody associated with the company,
and I
to make sure that they could fund next week's payroll.
And I gave them the hope speech, and they understood it really clearly, and they found the money, in fact, and eventually I think they found a buyer for their business. And they asked me for my candid assessment, which as an outsider and as a lawyer, it's hard to take the risk and say, well, it looks like you've done all the right things and you're getting the money, so I don't think you'll get sued. Well, you don't normally get that from lawyers, and you probably won't get that from your lawyer.
Which comes back to my stakeholder analysis, which is where I'm heading for those people. I think in the law, they're screwed. But on a stakeholder analysis, if I look to my government, well, you're going to get dinged for deemed trust no matter what, right? So you have that risk that you're taking. And if you understand that risk, God bless you, right? But you have that risk. You don't have a bank in that situation, right? You weren't able to borrow money, your pre-revenue, so that's not an issue. Your landlord is not a personal liability issue for the directors, and you don't have very much in supplier credit because you're pre-revenue. So really, and if you do, just disclose to them the situation you're in, pay up front, don't extend credit, don't accept credit that is extended to you, and you've really, I think, in those situations mitigated your risk, notwithstanding that, as you just said, the law is completely against you.
And
Is that a fair analysis?
I think while it's a fair analysis, I wouldn't counsel it as a legal counsel, right?
Yeah, exactly.
I'm not going to tell you to go ahead and do that. That's not prudent legal advice. But no, I mean, you're asking the question, who's going to sue me? Right.
That's exactly what I'm asking.
Right. So who's going to sue me? Well, that's a fair question. If I'm the lawyer giving advice on that, I'd say, well, they're capable of suing you. Whether they will or not is your determination. I can tell you who will be able to sue you and how much they will be able to sue you for.
Right.
And you can make the decision on whether you think they're going to do it and whether you want to play that game of economic chicken with another party. Absolutely, that's true.
Right.
What the startups have going for them that's a little bit different is most of them, by the time they get to this sort of running on fumes working capital situation, most of them actually then go out and they let a lot of the staff go because they're at the point now where they're trying to draw out their life long enough that they can reach the tree of life financing that they've been looking for, the angel investor, the uncle with the big cash or aunt that has the big cash that'll give it to. They're trying to drag it out, so they laid off 2/3 of their workforce already. And the people who are coming up and down the elevator every day are people who have some kind of an equity stake in the business, even if they are employees. And they've been told, look, we can't pay you. So what we'll do is we'll defer your salaries if you agree, and we'll paper that with you. They normally paper it.
Is that even legal?
Can you paper? Well, it's constructive dismissal, but again, the reality is these are people who are working in a small venture capital company with a big potential upside on the equity, and if the owner of the business is saying, "Look, take the risk and stick with me, and I'll give you more equity," then it's their choice. Can they still turn around and sue? It depends on every fact situation. I can't give you that answer.
Okay. And on that point,
but the point is that they're in it for a different reason, and they're not in it for the salary. And some of them have actually loaned money to the company. I mean, I can't tell you the number of scenarios where I find out that 3 of the key employees have actually loaned collectively, in a company that has a $50,000 a month cash burn, what's left of their cash flow, have loaned the company $250,000 because they have a belief in the company and they want their potential equity upside to take effect.
Yeah,
they almost become shareholder employees, with a different mindset.
Yeah.
How does that work out for them? I would tell you it's not the best structure.
Yeah, but that's a high risk business. If you're a VC, you're going to get 1 or 2 out of 10 that are a hit, right? It's the same for the employee that rolled their salary into the deal.
Right.
Why would they experience
those employees will come out of it very well, and there'll be deep loyalty to them.
If there's exactly.
As long as there's no dilution event later on, because that's the other part of that sort of structure. There can be a diluting event where more money comes in, and what you thought was your great equity position is now 1/10 of the great equity position. Yeah. So why did I make that loan, and why did I stick around?
Yeah, I wanted to make clear, and this seems like a good time, that you're not providing legal advice to anybody. We have a global audience. You're a Canadian lawyer. Ontario lawyer. I think that the concepts correct me if I'm wrong, but I think they're applicable in every British common law derived country, the concepts of it, not the specifics of it, and maybe even in many civil law jurisdictions, but you're not giving legal advice and the specifics are tied to case facts. Is it, you clarify that for me if you want.
Yeah, I mean, to put it simply, we're having a conversation about vague scenarios. We're providing information around it. If people want more detailed advice that's specific to their fact situation, if they're in Ontario or sort of British Columbia, Alberta, Ontario, or Quebec, I can get them help from some of the people in my office.
Yeah.
Or if they're in Ontario, I can help them myself.
Or internationally through your firm, right? I mean, you're an international.
Right. We have
firm.
offices in London. I mean, it is the director liability can be more severe in the EU. You know, you have to be
way more severe. I've been director in severe in the same situation.
I wouldn't be a director of a company in Germany or
you know me. All right.
You just don't take my advice enough.
Yet here I am.
Yeah, you're doing fine.
Okay, I'm going to walk us through what I believe to be, in Canada at least, the ways that you can get personally liable as a director. We're going to talk a little more in depth. I've spent 35 minutes of our hour sitting at the table. So, so we're going to be a little more in depth on a couple of them. And then we're just going to touch briefly on the ones that are important, but they're not necessarily relevant to the everyday business owner, I don't think. But you'll correct me where I'm wrong. And the first thing on my notes was insolvency, which is trading in insolvent, which we've already talked about a lot. So the hardest thing for me at the end of the day in all of this is if the company is troubled, when do you pull the plug? And because I don't care what anybody says, that's completely a judgment, and everybody's judgment is different. So we've talked a lot about this already, but the one main question that we haven't talked about yet that I want to ask you, because this show is about winning momentum. It's about direction. It's about changing it's never, for me, it's never about was the turnaround absolute. Did the direction of this company change? Is it still getting worse or is it getting better? Does direction matter in this situation? Because to me, you talk about hope, and hope is justified if things are getting better. Maybe hope is not justified if things just continue to get worse every day. Do you have any thoughts about that?
Yeah. Look, if you're beating your head against a wall and you're not getting where you hope to get or expected reasonably, I'll do it this way. If you're not getting where you're reasonably expected to get, and you're not even getting where you hope to get, then your situation is worsening, because the passage of time worsens your situation when you have a finite liquidity solution, right? And so unless you've got an answer, the more time passes, the harder it gets for you to justify keeping the doors open, you know?
Yeah.
You don't have to file bankruptcy. You just have to shut the doors.
Yeah.
Right? You have to stop.
So one thing that I think
to stop incurring liabilities when you reasonably know they're not going to get paid back. We call it tearing the rose-colored glasses off of somebody's face.
Right.
You gotta tear the people. They hold on to them like this. You know, you gotta tear them off. And sometimes you do have to tear them off. And sometimes people are sitting in the. If you're narrow and the city's burning and you're still fiddling.
Yeah. So one thing that we're going to talk about at the end is, how do you mitigate this as a director? What do you do to protect yourself as much as possible from any one of these scenarios? And one of the answers to that, to me, is to get a opinion, and I don't mean a legal opinion from your world, but to get some advice, preferably in writing, from somebody else who's a professional. So you go to a lawyer like you and say, here's my situation. What can I do? What are my options? And someone like you is going to say, you need to go through a bankruptcy proceeding, or you can do this until that. And I have some examples of that. We'll talk about it in a minute. But as much as possible, there's a due diligence defense in almost everything for a director. And if you go out to third parties to make sure that you're not unduly influenced by your ambition for this company, and get some objective professional opinion, that's always a good thing. Do you agree?
Yeah, I do. I think, look, if I can point to two directors' duties, because they have in them, built into them, that concept of due diligence. I'm going to read them and I apologize. The duty to act honestly and in good faith with a view to the best interests of the corporation, to avoid conflicts of interest with the corporation, and to not abuse their position for personal benefit. That's duty number one. The second one, which really goes to the heart of what you're saying, is to exercise the care, diligence, and skill that a reasonably prudent person would exercise in comparable circumstances by making decisions on an informed and rational basis, with diligence and after appropriate deliberation, having regard to all the circumstances about which they knew or ought to have known.
What law is that what are you reading from? Is that the BI?
That's a summary of the corporate statutes
in the Ontario Business Corporations
and
Act,
the CBCA and the OBCA corporate
the CBCA,
statutes,
yeah, okay.
and the OBCA. And what directors and officers are fiduciaries, and by definition, a fiduciary has a duty to dig deeper. Right now, they're fiduciaries to the corporation, and they're fiduciaries to the shareholders of the corporation. They're not fiduciaries to creditors.
Yeah.
And
they're not fiduciaries to creditors, really?
No, and there's a Supreme Court of Canada, the People's Jewelers case that went to the Supreme Court of Canada many years ago, came to the conclusion that the directors do not owe a duty of care to the creditors per se. That it doesn't shift. That somehow, when you get on the eve of insolvency, you no longer owe a duty to the shareholders because they're out of the money, and you now owe your duty to the creditors because
under the BIA rather than the Business Corporation Act. Under the business, I shouldn't use acronyms. The Insolvency Act rather than corporations law.
But they say corporations law is corporations law. You don't owe that duty to creditors. That doesn't mean you're excused when you act clearly in a way that is oppressive to them, right? Which we'll talk about the oppression.
So you can't scoop the sweep account funds.
Fraud, personal, and again, back to that, not abuse their position for personal benefits, right? And if you think about it, this duty of due diligence, I think it's not enough to just go out and hire somebody and get a rubber stamp opinion that says, yeah, you can do it that way. Because, I'm sure there's people that would give you that.
Totally. There's a whole movement in the U.S.
You have to use your judgment. You have to canvass the circumstances, and you have to canvass the alternatives and think about what the implications of your decision are on each of your stakeholders. And then you make a rational business judgment decision.
Yeah.
Courts are generally speaking, don't get angry about and point at you when you've exercised reasonable and prudent business judgment in the circumstances, right? There's other stakeholders. The environment is a stakeholder. The community you're in is a stakeholder.
Yeah.
Canada is a stakeholder. The employee is a stakeholder. The creditors are a stakeholder. This was that whole point that I made a little earlier about you've got a lot of competing interests, and you have to balance them off and do what's best for the corporation in the circumstance with a mind to all of those stakeholders. Not to the exclusion of them, and only to the mind of you as a shareholder.
So this duty of care thing, on the Martinis with Scott show, I've talked a lot about CanTrust. And I know you're not on the file, so you're not an expert on that. But, anybody in Canada generally knows that issue. And it's always been interesting to me. I've done a couple of shows with Jay Richardson, who is one of my go-to guys for just an independent director, audit committee chairman type fellow. And he's also involved in the cannabis space, so he knows that file. And I think I had one with Mathers on at the same time, Chris Mathers, who's an investigative, white collar crime, money laundering sort of fellow. It's great stuff. And my thing was about the directors as a whole, but also the independent directors. And so the scenario there was that there was an alleged or factual, I don't know which, you guys can go look it up if you're watching the show, but they built a false wall and they grew illegal plants, cannabis plants, behind the false wall, and they lied to the regulator, which was Health Canada, and there was a whistleblower, and they got caught, and they're bankrupt. Well, they're in CCAA now, and they've got they blew $1 billion, $1.5 billion of market cap, and they're screwed. That's the bottom line. And the interesting thing to me, there's all sorts of, I did a whole show called How Not to Do a Turnaround. There was a terrible handling of that crisis. But the interesting to me is they're in Toronto. They have one growing facility. So they have two facilities, I believe. One's processing, but one growing, and it's in Niagara. So the independent directors had to get off their ass and drive an hour and a half down the QEW and walk through that place and see a fake wall, right? So now I believe they're all being sued I think there's about $500 million of class action suits that are being consolidated into the CCAA process. Do your job. That to me is duty of care, right? Do your job, get off, drive down, know your business. You can't just sit as an independent and collect your fees and rubber stamp stuff.
I agree. I don't think they have a forensic obligation to go down and find false walls, though. I don't.
But if you walked through the facility, if you were mildly curious, you would have seen a wall that was more of a tarp with shit growing behind it. I'm not. Don't use it as that specific example because I know that puts you on a spot. Generically speaking,
it's not just. But I mean, even in the hypothetical scenario of I was making bootleg alcohol in the back room of the restaurant, and I was on the board of directors of the restaurant, and I didn't know they were making bootleg alcohol in the back. If I didn't have anything that twigged me to it, and I didn't have an apprehension of it, to say that I had an obligation to go down and start poking around the drywall to see what was behind it, I think starts to come into if I'm an independent director, it doesn't mean that I'm taking care and management of the operation of the business. I'm trusting the officers of the company to do that. I'm relying on the integrity of the officers. If I have aligned myself with stupid, crooked officers who have a bootleg brewing business behind the wall in my restaurant, then I look stupid, but I'm probably not liable for that. I'm dumb. I'm dumb. I should never get another director's role, and I picked the wrong people. But I say that, and that sounds really trite. But here's the flip side of that. There's a lot of CEOs and officers who might not be the most honest people in the world, who could sell you that bill of goods and you'd believe them. But by its nature, small and growing businesses have promoters at the helm of them, and the promoters often will overstate their circumstances and overstate the finances and overstate. And my answer to that is if you're on the board of directors of a corporation and there's a promoter at the helm, you better have a really good CFO. And if the CFO and the president are at odds with each other, and you want a CFO who's a CA, and if you've got a CFO who's a CA and they're at odds with each other, and the president fires the CFO, that's your smoking gun problem of somebody is not prepared to put their personal, professional reputation at stake for the business.
Right.
So I like.
By the way,
I like CFOs who are CFAs. Doesn't mean every CA is an honest CPA or CA or CPAs. It doesn't mean everyone is squeaky clean. I mean, there's a percentage of all populations that are less than honest. But there's a circumstantial guarantee of trustworthiness that comes with the designation, and a lot of training and a lot of care taken every year to make sure that you're updating that training about ethics. It's driven into you. And so as a board member, I turn as much to the CFO as I would to the CEO.
Yeah. Okay. Switching topics. Listen, you're probably the Canadian legal expert on this particular issue. Directors and officers liability. Just go with it. Don't argue with me.
I know. I'm gonna stop you there. I have a lot of friends in the industry. They're all very smart. I'm happy to recommend them. There are endless numbers.
Tell me who.
I'm
kidding you. Okay. Oppression claims was on your notes to me.
Yeah.
And I did not know oppression was a director liability. So I want you to, first of all, very few people know like normal business people don't know what an oppression claim is. So explain that. And then tell me in what circumstances it's a director liability as opposed to a corporate liability.
All right. So the oppression, corporations are capable of being oppressive, but an oppressive is unduly disregarding or injuring the interest of a stakeholder in the business. And that's a really overgeneralized way of saying it, but it's basically it's mistreating a minority shareholder.
You signaled out this stakeholder and treated them unfairly.
Yeah, or you took an action that was so heinous that you should have seen that it was going to have that impact on it. You know, but who makes those decisions, right? So what's the point of if somebody has made a bunch of bad decisions and the company is insolvent as a consequence, and now the corporation is liable for the oppression, but you're an unsecured creditor of an insolvent
corporation.
So who are you going to turn to? You're going to look at the oppression remedy gives you the right to look to the people who made the decision, the actual decision makers, who often are shareholders and major shareholders. Often.
Does it really?
Yeah.
See, because I would have thought, so the oppression creates the liability against the corporation, and then you say, well, they're insolvent, that company, and so this director he didn't have a duty of care, he didn't fulfill his fiduciary, he breached trust, whatever it is, and therefore I can go forward. But you're saying it's directly in the oppression law.
Yeah, and actually,
or maybe both.
You can actually even go back against shareholders with oppression.
Yeah, sure, why not?
It doesn't. It's there's lots of cases where oppression has been levied as a claim. It's a higher standard. Like the duty of care of directors is here. Proving that they've been oppressive is harder to hit. So
on that point, because I don't want to turn this into a legal argument for these people, but on that point, and I don't know if it's directly to oppression or breach of trust or whatever. I was always amazed at Afria, which was another show that we did at a cannabis company in Canada. And they were accused, and I don't think there was any pushback on it. They were accused of effectively front-running M&A deals into a public company in a hot market. So they would go to Jamaica was one example, and when there was another one in South America, and they basically bought something for, a pebble, not even currency, like it cost them nothing. I think there was one that was literally $800. Literally $800 to buy whatever the shell was. They flipped it through a bunch of shells, a corporate chain, ended up into the public company that was hot for tens and tens of millions of dollars. And there was a bunch of those that added up to whatever, 750, $1 billion, like a lot of value, okay? And the shareholders, one of the shareholders was accused of being part of that front-running scheme, as was the promoter in front of it. And what amazed me is their defense was not that we didn't do that. Their defense was, we hired these people and paid a lot of money for a fairness opinion. We had legal due diligence. We got legal opinions and all this sort of stuff. And there's all our professional reports. And that was kind of the end of it.
So did Conrad Black.
Wasn't the end of it for him.
That's my point. Depends on that. That's a question of again, who did you annoy, and how hard do you think they're going to fight you?
Okay.
That goes back to look, the standards are fraud, really hard to prove, right? Criminal level of culpability, oppression, monetary damages, fairly high standard to prove.
Yeah.
breach of fiduciary duty.
Yeah.
Right? So if you can't get them on breach of fiduciary duty, or if you can get them on oppression, you've probably got them on breach of, but they have to have owed you the fiduciary duty. So if they don't owe you the fiduciary duty, but they've nonetheless done something egregious to you, you go after them for oppression.
Right. So
fraud. Look, I will tell you that just because businesses and people get away with this does not mean
sure. But my point is not that. My point is clearly you should not be doing that.
Right.
But regardless, what you ought to be doing as a director is getting those sorts of, spending the money to get those sorts of professional reports and keeping them on file. That's my point. Right.
Right.
Talking to people
it's going to be harder to get that. It's going to be harder to get that from lawyers after the Conrad
than financial people.
Well,
yes.
After the Conrad Black case, because the law firm in that case, I believe, was held liable.
Oh, really?
Yeah. There was a settlement. Well, I don't think it's public, but I think there was a settlement. I mean, my point is you have to be cautious with it. Good law firms are. The other thing is if you get that kind of an opinion from a really small accounting firm that's 2 members, that doesn't do that kind of work every day of the week, how much weight do you put on that, right?
Well, but you're talking about, can I sue that law firm afterwards? Can I sue that accounting firm afterwards? Whereas I'm talking about, I'm not an expert in this as a director. I went out to these professionals and I got an opinion, and that's what I decided to do. I was exercising my care, right? I got, and I'm not talking about it as a show. I think you just need to legitimately go out and get professional opinions on things that seem weird to you, and you need to keep that on file.
I agree with that. I just don't think that people should believe that you can go out and hire a lawyer and accountant and they'll generate it.
In general, you can't go to your
local. That satisfies and supports what you're doing. You're probably going to get something that ties your hands and says you can't do it, in fact. Right?
Well, yeah, right, because they're covering themselves on that side too.
It's kind of my point. That sort of, the day when that was done is past a little bit.
Interesting.
But you might find, but here's the thing. Smart lawyers and smart accountants have other ways of figuring out that you can do something. They can find another way, and that's a completely legitimate exercise. There might be other reasons for you other than to defeat, hinder, or delay creditors or to be unfairly prejudicial. There may be completely legitimate reasons to pick a particular structure and a particular way of doing things. And you can justify what you do with, legitimate reasons. But if behind it all, you've got this sort of devious intent, that's going to come out.
Which is the real issue.
Right.
Exactly. All right. Statutory remittances, deemed trusts.
Unremitted source deductions.
Right.
Unremitted income taxes. This one is a director and officer liability. If you haven't taken the source deductions from your employees and remitted them, you have essentially stolen money. That was the employee's money that was going to the Crown to pay their taxes, and you were supposed to remit it for them. You've breached trust, and you've breached your duties, and you're going to be held liable by the Crown for that.
So this is an issue that doesn't compute for entrepreneurs, and I'll tell you why. Because the salary they have to pay this person this pay period is, say, $1,000. The net pay to the employee is $600. I'm just making up numbers. And the Americans are going to freak out by the 600-400 split, but so 600 to the employee and 400 to the government, except I only have 600 in the bank. So I paid the 600. I didn't pay the 400 to the government. I didn't steal that money. I never had it to begin with. That's what they think.
You allowed your employees to come to work and earn the 1,000.
That's right.
You agreed to pay it to them, and now you were supposed to pay them and if you could pay them the 600, you have to be able to pay the 400 to the Crown. And if you don't pay the 400 to the Crown, you are on the hook personally.
Period.
There's no due diligence defense to that.
Well, there is if you didn't make the decision. Correct me if I'm wrong. So what I do as a director is I want an officer certificate I want my people to sign literally sign a certificate once a month to me saying I paid everything I was supposed to pay. Then I'm more or less covered, correct?
Yeah, you have to, I mean, if you've set a system up and it's all supposed to be done, and you're relying on the officers of the corporation to exercise it, then you have some level of defense, though. I'm not a person who advises clients they should rely on defenses. They should rely on proper diligence.
No, for sure. But that is part of if you're a director, what do you practically do? If you're not, say you're an independent director and you're not part of this, well, then you need to rely on your officers and sign a certificate as best you can. Let's talk about vacation pay, because that's a massive one. So if you're running let's say something with a lot of employees, a manufacturing company, and you've got 200 employees, and on average they're getting 2 to 3 weeks, and they're not taking it because you're really busy, and all of a sudden, I mean, it's so easy. You've got $500,000 of accrued vacation pay.
Yeah.
Directors never think about that. Personally liable in a lot of jurisdictions.
Yes, and it's the first thing I raise with the board when I walk in the door.
And
I tell them that they have to, it's not just that. There's a number of these liabilities, HST, director's liabilities, and you have to have a professional assessment of what your real cash flow is to be able to know how long you can go on the papers. And if what you're doing is you're going in and you're saying, well, I can pay the salaries up until this date, and you haven't factored in the other hidden liabilities and paid those as well, you're exposing yourself as a director, 100%.
So as a director, are you liable in your jurisdiction in Ontario? Are you liable for 100% of that vacation pay?
Yes.
Wow. And so how do you mitigate that? Because I like pay it out. If they're not taking their vacation, you can write them a check over time. What about use it or lose it policies? Because that's what I do.
I mean, it's an employment law issue in terms of what the contract says, what their entitlement to vacation pay is. You can contract for the vacation pay entitlement as long as you comply with the labor code of the province within which you.
Right. So as a director, what I say is, look, we're running a manufacturing company. You need some time off. You should be using your 3 weeks. And if you're not using their 3 weeks, I'm not going to accrue this thing and make it my personal liability when something goes wrong. So December 31, if that's my year end, you're not getting your, we're just canceling that. We start a new year. And so I use it and lose it policy, which I think is legal in a lot of jurisdictions, and it mitigates that risk.
Right. The only thing is that if you're in the year and if your fiscal year is, January 1 to December 31, and you're running out of cash in November, you could have a significant accrued liability that they're still entitled to use.
For sure. But David, that's not what happens in reality. That happens. But in addition to that, you've got 4 years of back vacation. That's a real problem. So, and it just adds up.
We don't generally see 4 years of back vacation in No, we see that stuff getting paid up that either gets settled or canceled depending on the contract, immediately following the fiscal year end. People don't let that vacation pay accrue for you.
I see it all the time. I said, maybe you're dealing with a lot more sophistication than I'm dealing with on a day-to-day basis, but all the time, I just see this massive vacation pay accrual that no one's thinking about.
Yeah, I mean, the businesses that I'm being called into generally have revenue, north of what, $50 million. If you're in a business over $50 million of revenue, you're probably properly managing your vacation pay.
But not for sure. All right, let's just plow through some of the last ones. I don't know if we need to talk about any of this. Piercing the corporate veil, anything like good faith and commercial dealings, declaring dividends, misrepresentation claims.
Declaring dividends, right? If you're insolvent, if you're insolvent, you can't dividend money out to yourself.
Right.
It's real simple. Directors are liable for that.
And are dividends in that law, is that literally signing a resolution for a dividend, or is it suck money out at all for yourself that's beyond the normal commercial reasons?
It's the statute with respect to something that's contemplated as a dividend or the equivalent of a dividend under securities law.
Right. So what I think for people to understand is I have multiple, if I'm a business owner, I have multiple hats. I have my director hat, I've got my employee hat, I've got my shareholder hat. And if I'm heading towards insolvency, I need to think long and hard about which hat has priority and which hat ranks at the bottom. And so I can get paid as an employee, but I can't suck money out as a shareholder. And I don't care if that's as a dividend or a loan or a bonus or anything.
I mean, there it is, though, right? You're within 3 months. You're in the zone of insolvency, and you give yourself a bonus.
Exactly.
Right.
So that's not a dividend, but
not
you're sucking money out
but
that you didn't deserve.
But it's oppressive.
Yeah.
That's going to be oppression. If you want a definition of oppression,
that's it right there.
That's probably it. Yeah.
All right. So,
but Scott, that's the problem. Is look, there are as many situations and scenarios as there are people and behaviors, and we couldn't, in a month of Sundays, we couldn't, with some comfort, describe every conceivable situation, but every one of them has a smell test associated with it.
Yeah.
So the real question is does this smell? Am I self-dealing? If I'm self-dealing, then I'm probably going to be on the hook for it. It's really not that hard.
This is not rocket science. Well, it's not rocket science from afar, from the outside advising. But if you're in the middle of the shitstorm, whether that be high growth, exciting chaos, like I'm going to be a billionaire kind of vibe, or you're in the relentless, endless, crazy stress of going downhill, you can't see the forest for the trees. People cannot see the forest for the trees. That's just a fact. And even when I'm more experienced than maybe everybody. And when I throw myself in that situation, it's hard. Like I need to force myself to step back. So get advisors, get good counsel, get a board of directors that are independent to help you see that forest for the trees.
So yes, I completely agree with that, 100%. But I'm also going to tell you that I don't buy it for an instant. Look, self-dealing is really, when you're doing something that is for yourself, you might rationalize it all you want.
That's the point.
And you can rationalize it all you want, but somewhere right deep in here, the moment you do it, you're thinking to yourself, maybe I shouldn't have done that.
After it didn't feel good.
It didn't feel good, right? The whole idea that somebody can march through life and not be aware of the chaos that they create. If they're again narcissists, sure, but or sociopaths who have no, zero EQ and 100% narcissistic personality disorder. But I'm not, and by the way, if you're so sufficiently unaware of yourself to sit across the table from me and I'm acting for a creditor, and you sit there and go, I don't know, it sounded like a good idea to me to pay myself that. I'm going to eviscerate you. I'm going to turn to the client and say, there's no point in having this conversation. Game on, and dude, lawyer up. It's time. And so, what people sort of.
And you are a bag the shoe on the table sort of.
Yeah, I am. I'm gonna. It's not gonna be a pleasant moment. And what happens after that is not going to be a pleasant moment. Nobody's going to chase anybody for $5,000. But if you've taken $3 million out, you've put it into the family home or buried it in a box in your backyard, and my client's out $5 million or $3 million in your business. First of all, I'm going to have to hold my client back from going across the table at you. And the second thing is I'm going to get instructions to bury you alive. and put my thumb over the hole every 5 minutes, so to remind you that you're buried alive. I mean, no, but it's real wrongdoing, even if you're gleefully unaware of it. Real wrongdoing attracts the attention of the bench too. Look, judges, we have really amazing judges in Ontario, and they have incredible, I'm going to say a bad word, bullshit filters, right? They have great bullshit filters, and they'll sit there and they'll look at it, and they won't necessarily call it out. If all the lawyers in the room are doing their jobs, they won't call it out. They'll just decide a certain way. But if a owner of a business stands up and continues to protest, it continues to protest, at some point the judge is just going to look at them and go, "You're paying everybody else's costs in this room." And when the judge says that to you, and it happened recently in a CCAA.
That's a tell. You're going to tell me that's a tell?
That's the end. That's the last tell. That's right before you lose everything, right?
Yeah.
And so I got that's what we call the chutzpah defense, right? You heard this, the chutzpah defense? I'll tell a joke now, folks.
Yeah, do it.
A son kills both of his parents, and he's found guilty. It's obvious he did it, and he admits to it. And when he comes before the judge for sentencing, the judge asks him, "Is there anything that mitigates these circumstances? Is there anything that, like, I shouldn't just throw the book at you?" And the son stands up and says, "I'm an orphan." Right? Like the orphan, we'll sit in court, and if somebody stands up and makes a statement that's absolutely defying gravity, we will sit in the back and lean over to each other and go, "Another orphan defense." That was the orphan defense. I'm not being glib about this. Look, business people are smart. In 30 years of practice, I have not run into, in the companies that I've seen, and I've seen a lot of distressed companies, I have run into incredibly few people who aren't both self-aware and aren't, pretty smart, actually, to be where they are. Most people's businesses don't fail because, they fail because they took too much risk, but it's not because the person made a stupid choice. And so you sit there, and if you sit there, I have a lot of faith in business people to be able to look in the mirror and go, "Okay, I'm going to take a pause. I know that decision is in front of the company. I'm going to breathe. I'm going to go for a walk. I'm going to come back. I'm going to look in the mirror, and I'm going to say, this is what I want to do." And I'm looking in the mirror, and if I start to laugh at myself, I'm pretty sure I shouldn't be doing it.
Yeah.
You got to.
What a great thing to end on. David, tell us about Gowling and you, and if you want people to reach you, how would they do that?
So if you go to www.gowling, GOWLING, you'll find me there under the people section of the website, David Cohen.
David Cohen.
Cohen. I had our financial services industry group for Canada. And we are a multinational firm in here with large offices in Toronto, Montreal, Vancouver, Calgary, Ottawa, London, England, and abroad. And we practice restructuring and financial services law in a very big way in this country. I've been doing it for 30 years. You can call me if you need to just bounce something off of me and have a conversation. You'll find me on the webpage. Scott, maybe you can post I'll
put it in the notes for sure.
My bio in the notes, and people can reach out to me. First conversation is free. It might only be 20 minutes, but I'm happy to have a chat with you and help. We're here to help.
Hey, David,
I'm in the business of keeping businesses out of insolvency proceedings. I'm in the business of helping people find solutions, right? Or if I'm putting the other hat on, getting the money back when somebody hasn't
Right.
done it the right way.
Right. Now, would you offer to other people, the audience of this show, the same thing you offered to me, which is that no matter what the issue, whether it be securities or employment law or things that you don't practice, you'll hook them up in the firm?
Yeah, 100%. I mean, you know, Scott, that you've made referrals through me for IP, corporate law, real estate transactions, and I've done the same thing. I have a lot of corporate clients that actually use me as the conduit to the firm.
As a relationship partner.
And I'm also I'm not a litigator. I don't go to court. I'm a solicitor. I'm a corporate lawyer. I do mergers and acquisitions. I do debt financing, and I do insolvency and restructuring work. I happen to love insolvency and restructuring because it's allows you to be creative. It's fun. It's challenging, and it's very fast paced. And the people that you work with on both sides of the table are smart, articulate people who really get it and move quickly.
Thank you so much, my friend. This has been fun.
Thank you. I hope this was helpful to your audience. Take care, all.